Massive beat for Moody's this morning. They absolutely crushed consensus estimates across the board.
Yeah, they really did. I mean, total revenue came in at $2.185 billion,
Yeah.
which is up 15% year over year.
And adjusted diluted EPS skyrocketed 31% to $4.68. Plus, they raised their full-year guidance to a range of $16.50 to $17.
Right, and unsurprisingly, the stock is reacting incredibly well to this, popping in early trading. Because, those are just monster numbers for a legacy financial company.
Exactly. So now that we've got those headline numbers out of the way, let's actually unpack this. Today, we're doing a deep dive into how they pulled this off, using their official Q2 2026 earnings presentation, the press release, and those supplemental financial tables they provide.
Because this is far more than just an exercise in crunching quarterly numbers. A company like Moody's is uniquely positioned. They're rating the debt for virtually every major project and corporate acquisition on the planet. So their earnings report is actually a real-time reflection of what the global economy is doing right now. So basically a macroeconomic barometer.
Our mission today is to look past all that dense financial jargon. We want to extract the vital insights about why Moody's just posted this historically unusual quarter, what's driving the boom, and what their internal forecasts reveal about the broader global economy over the next year.
And you mentioned that 15% revenue jump earlier. For a mature 117-year-old institution, that is enormous. Moody's isn't some scrappy software startup.
Yeah, at that sheer scale, it shows tremendous momentum. But the revenue is just the starting point. I really want to look at their profitability. That adjusted diluted EPS jumping 31%. When we say adjusted diluted, just to be totally clear, what are we actually looking at?
It's an important distinction. So diluted means the company is calculating its profit per share, assuming that every single stock, option, or warrant out there has been cashed in.
Okay, so it's the most conservative way to look at it.
Exactly. It's the worst-case scenario for how profit is divided up among shareholders. And the adjusted part just means they're stripping out one-time accounting anomalies like settling a weird lawsuit or something, so you get a clear picture of the actual day-to-day business.
Got it. So the core engine of the company is vastly more profitable than it was a year ago.
Vastly.
Which brings us to a stat that I really want you to break down, and that's the margin. Their adjusted operating margin expanded by 440 basis points, hitting 55.3%. Now, we hear basis points thrown around on financial news all the time, but just to clarify for everyone listening, a basis point is just 1/100th of 1%, right?
Yeah, that's exactly right. 1 basis point is 0.01%.
So why not just say percentages?
Well, because when you're dealing with trillions of dollars, fractions of a percent matter immensely. Saying a rate changed by 0.25% can sound ambiguous depending on your baseline, but saying it moved by 25 basis points is mathematically precise.
Right, that makes sense. So a 440 basis point expansion means their profitability margin improved by 4.4 full percentage points in just a single year.
Right. And what's fascinating here is just how perfectly this illustrates the concept of operating leverage.
Oh, because if they increased their revenue by 15%, but their earnings per share jumped 31%, it means their costs didn't go up anywhere near as fast as their sales did.
Precisely. They have high operating leverage. Their fixed costs are largely locked in. They've already paid for the highly trained analysts, the Manhattan office buildings, the massive data servers.
So when a surge of new revenue comes in, they don't have to go out and hire 15% more people to handle it.
Exactly. A disproportionately large amount of that new money just drops straight past the expense column and lands right on the bottom line as pure profit. For a company of this size, hitting a 55.3% margin is just a staggering display of corporate efficiency.
And we know exactly where that surge of revenue came from, too. So Moody's operates in two main halves, right? And the traditional ratings business Moody's Investors Service, or MIS, was the primary driver here.
Oh, absolutely.
MIS delivered $1.26 billion in revenue on its own, which is up 25%. And they did this by rating over $2 trillion in debt for the second consecutive quarter. $2 trillion with a T.
Yeah, and to tie that back to the margins we were just talking about, that MIS segment actually saw its adjusted operating margin go up to an incredible 68.3%.
Wow.
I mean, almost 70 cents of every dollar they bring in from rating debt is operating profit. And the transaction revenue within that was up 34%.
Yeah.
It just highlights how directly global debt issuance fuels their model.
I'm looking at these numbers and I have to ask, are rating agencies basically just the toll booths on the global financial highway? Like if you want to drive your newly minted corporate bond down the road to investors, you have to stop and pay Moody's the toll to get the stamp of approval.
That's exactly what they are.
But let me push back a little here. If they're just sitting at the toll booth collecting fees every time a company issues debt, doesn't that make them inherently vulnerable? Like, what if the highway gets shut down?
Right.
What if there's an interest rate shock or a massive credit freeze and companies just stop borrowing money? Aren't they entirely at the mercy of the macroeconomic weather?
Is a totally valid question. And historically, yeah, the ratings business is highly cyclical. When debt markets slow down, that transaction revenue drops off a cliff.
Right.
But to understand why they're booming right now, despite all the global uncertainty, you have to look closer at the data to see exactly who is paying that toll and why they're taking on so much debt right now.
Okay, so if traditional corporate borrowing is, relatively stable, what specific sector is suddenly desperate enough for cash to drive a 34% transaction revenue spike?
Well, if you look at the breakdown of the MIS segment, corporate finance was up a healthy 27%.
Led by strong investment grade and leveraged finance activity, the report says.
Yeah, but the real standout, the absolute eye-catcher, is the public, project, and infrastructure finance segment, PPIF. That specific line of business saw a massive 38% revenue growth.
And what's driving that? Because usually infrastructure means like municipal bonds for bridges and highways, right?
Normally, yes.
Yeah.
But in their presentation, management specifically cited issuance activity related to data centers. It's the broader build-out of technology infrastructure that's acting as the primary catalyst here.
Wow. Okay, here's where it gets really interesting.
Yeah.
Because we spend so much time analyzing the global AI arms race, everyone is hunting for the next hot AI startup to invest in or watching big tech fight over silicon chips.
Right.
But sitting quietly in the background is this 117-year-old legacy financial company, and they are generating massive cash flows just by rating the debt used to build the physical servers where that AI will live.
It's the classic selling shovels during a gold rush scenario, just executed on a macroeconomic scale.
Right.
Building the physical infrastructure for AI requires unbelievable amounts of capital.
Yep.
The sources explicitly cite projections that hyperscaler capital expenditures, their CapEx, are going to near $1 trillion in 2027.
$1 trillion just for capital expenditures. I mean, you don't just find $1 trillion under the couch cushions.
You certainly don't. And how these tech giants fund that is crucial. Even companies sitting on massive piles of cash often prefer to issue debt for these mega projects. Debt financing can be cheaper than equity, there are tax shields on the interest, and it lets them preserve their cash.
So they raise that $1 trillion by issuing corporate bonds.
Exactly. And before institutional investors like pension funds are legally allowed to buy those bonds, they absolutely need a trusted rating.
So as long as the AI gold rush continues, the corporate debt keeps flowing, and Moody's keeps collecting the toll.
Yeah.
But that brings us back to my earlier pushback. If the transaction toll booth is vulnerable to a market freeze, what is Moody's actually doing to bulletproof their balance sheet? Like, when this AI hype eventually cools down, how do they protect themselves from being just a cyclical victim?
That is where the second half of their business comes in. Moody's Analytics, or MA. If the investor service division is the cyclical engine, Moody's Analytics is the shield. It's their financial shock absorber.
Let's look at the performance for MA then. For Q2, Moody's Analytics brought in $925 million in revenue. Now, on the surface, that looks a little sluggish compared to the explosive rating side. It's only a 4% increase year over year.
True, but you have to look at the supplementary tables. They highlight a metric called ARR, annualized recurring revenue. That number is sitting at $3.7 billion, up 9%.
Oh, wow.
Yeah, and they boast a stellar 95% retention rate. Plus, Decision Solutions, which is stuff like KYC and banking software, grew 10% in ARR.
So if we connect this to the bigger picture, that recurring revenue means this is subscription-style income.
Exactly. These are global banks and asset managers paying Moody's year after year for deep economic research and compliance tools. And that 95% retention rate tells you these aren't just nice-to-have luxuries, they are deeply embedded operational necessities.
Once a bank integrates Moody's risk models, they basically never rip them out.
Almost never.
Okay, wait, I need to do a quick math check here, though. I'm looking at these two figures and I'm a little confused. If their recurring revenue is growing at a really healthy 9% and retention is 95%, why is the top-line segment revenue for MA only showing a 4% growth? Where did the rest of it go?
It's a great catch. And the answer comes down to divestitures. Over the past year, Moody's sold off a couple of non-core businesses, specifically their learning solutions and regulatory solutions divisions.
Ah, yeah.
So when you sell off a piece of your business, you instantly lose that raw revenue on the income statement, which creates this temporary statistical drag on your top-line growth.
So it looks worse than it is.
Right. If you strip away the mathematical impact of those divestitures and adjust for foreign exchange rates, they report that MA's organic constant currency growth is actually 8%.
Okay, that makes total sense. So the 4% is just the messy surface number, but underneath the core analytics business is humming along at 8 or 9%.
Yeah.
And that 3.7 billion in recurring revenue essentially smooths out the ride for the whole corporation. If the debt markets freeze up tomorrow, they still have billions in subscription money rolling in to keep the lights on and keep those margins healthy.
It's a beautifully balanced structural hedge, massive upside during the good times, heavily protected by sticky software revenue during the bad times.
Which means Moody's isn't just reacting to the economy, they have a literal front row seat to analyzing it. And their internal guidance for the rest of 2026 relies on their own proprietary macroeconomic forecasts.
Right, which gives us a really fascinating window into how they see the world shaping up over the next 6 to 12 months.
Let's look at their specific metrics. They are assuming U.S. real GDP growth of 1.5 to 2.5%, and the euro area growing a bit slower at 0.5 to 1.5%.
So notably optimistic, but very measured. No runaway growth, but no crash either.
Yeah, and they expect central banks to maintain what they call a tightening bias, so maybe one Fed rate increase and one ECB hike in 2026. Global speculative grade default rates are forecasted to finish around 3%. Oh, and here's a big one. They expect announced mergers and acquisitions to increase by roughly 25%.
When you synthesize all of that, it's essentially a Goldilocks scenario for Moody's. The economy is growing, default rates at 3% are totally manageable, and that projected 25% jump in M&A is a huge forward-looking indicator.
Because if two massive companies merge, they usually need to borrow a mountain of money to fund it, which means more transaction revenue for Moody's.
Exactly.
So what does this all mean when we look at one specific, rather technical assumption they made? They stated they expect U.S. high-yield spreads to widen to approximately 330 basis points. Now, for you listening, a spread in this context is basically the extra interest a risky corporate borrower has to pay compared to a super safe borrower, like the U.S. government.
Right.
So a widening spread. Is that basically just an insurance premium? Like lenders are getting a little nervous about bad drivers, so they're hiking the rates for everyone with a spotty financial record.
That is a highly accurate way to look at it. The risk premium is going up slightly. Lenders are demanding just a bit more compensation for taking on debt from riskier companies.
Okay.
But context is everything here. While the spread is widening to 330 basis points, Moody's is careful to note that this is still well below the historical average, which typically hovers around 500 basis points.
Oh, wow. So they're hiking the rates a little, but they're still feeling pretty safe overall.
Exactly. Capital is still relatively loose and willing to take a chance on corporate growth.
Okay, so tying this all together, we've got massive margins, steady recurring revenue, and a macroeconomic outlook that screams, keep the debt flowing. The natural result of all this is that Moody's is generating a massive amount of free cash flow.
A huge amount.
Yeah. And the final piece of the puzzle is how management plans to deploy that cash. They expect to generate free cash flow of between $2.7 and $2.9 billion for the year. And they announced they are raising their share repurchase guidance to up to $3.0 billion. Keeping in mind, they already bought back $2.2 billion worth of stock just in the first half of the year.
Which is very aggressive.
Plus, they're investing about $100 million in capital expenditures for office relocations in New York and London, and reinvesting in their global risk assessment strategy.
This raises an important question about how legacy companies maintain shareholder value. That $3 billion buyback signals profound confidence from the executive team. They aren't hoarding cash out of fear. By buying back their own stock, they're reducing the total number of shares available, which inherently makes every remaining share more valuable.
But let me play devil's advocate for a second. They are essentially eating their own shares. If they have $3 billion lying around, doesn't plowing it all into stock buybacks suggest that maybe they lack better ideas?
That's a fair question.
Like, does it mean they can't find any good external acquisition targets? Or is it simply that they look at their own balance sheet and genuinely believe that investing in themselves is the highest yielding option available?
It is almost certainly the latter. I mean, they are spending that $100 million on prime real estate and risk strategies, so they aren't just coasting. But honestly, when your adjusted operating margins in your core business are sitting at 68%.
Yeah, that's hard to beat.
It's very difficult to find an outside company to acquire that offers a better return on investment than just buying back your own highly profitable stock. Just highly disciplined capital allocation.
It really is a masterclass in balancing cyclical transaction growth with structural stability.
Absolutely.
So, just to quickly recap what we've uncovered from this Q2 report, we've got a company that just rated over $2 trillion in debt, driving a 15% revenue bump. We saw how the AI and data center build-out is creating a tidal wave of corporate debt that Moody's gets to toll. And their analytics business, with $3.7 billion in recurring revenue, provides this rock-solid foundation that lets management confidently buy back $3 billion of their own stock.
It's a company sitting at the exact intersection of global risk, proprietary data, and capital flow.
Which leaves us with a final thought to ponder. Buried in the glossary of this earnings report, Moody's mentions something called the Moody's Data Estate. It's a proprietary data foundation containing risk-related information covering more than 600 million entities globally.
600 million. That's just staggering.
We already know they're the gatekeepers of global debt. But if they take that massive data set and fully integrate it with advanced AI, what happens next?
Yeah, that's the real question.
Are we looking at a future where Moody's transitions from simply rating financial risk after a company asks for a loan to algorithmically dictating the flow of global capital before human analysts even see the numbers? When your data estate is that large, at what point do you stop predicting the market and start quietly running it?
It's a wild thought.
Something to think about next time you see a headline about corporate borrowing. Make sure you follow the show for daily earnings coverage. Thanks for joining us on this deep dive. I will catch you next time.